Hello, this is Dr. Mahmoud, and in this video, I will be talking about the break-even analysis, another financial measure that we use to look into the financial status of a company or of a project. So what is a break-even analysis? The break-even analysis is the point where we're not making any money, we're not losing any money. So that point where basically whatever money we're making, we are paying it toward the costs. So for example, in this chart that you see in front of you, what you have here, you have as a break-even point to be 10,000 units. And if we sold more than 10,000 units, we start to bring more revenue and profit. If we sold less than 10,000 units, that will make basically we will be losing money. So the break-even point is one of the financial measures used to find the point where the total cost equal to the total revenue. So we have the total cost right here, and that's the revenue in a blue line. So the break-even point is that point right there where the total cost equal to the total revenue. And we could calculate that using this equation that I listed here. Break-even quantity would be equal to the fixed cost divided by the sales price per unit minus the variable cost per unit. Also, what you could do, you could say, well, total cost equal to the total revenue and solve the equation for X. And this is basically where this equation coming from. Equation number 4 coming from the total cost equal to the total revenue. And this way you could solve the equation for X and find the break-even point. All right, let's take a look into this example, which is a Fresh Air LLC is a local company that sells water bottles with a fixed cost of 100,000, include the taxes, lease, and salaries. The variable cost for one water bottle is $2 per unit, and the water bottle is sold at a premium price of $12. Determine the break-even point. So using equation number 4, we said that going back to that equation for a little bit, fixed cost. So the fixed cost, we have it to be 100,000 divided by the selling price, which is $12 minus the $2. And that will give you 10,000 units. So in order to break even the cost, they have to sell 10,000 units. So what does that mean? That means they're not making money, they're not losing any money. Whatever money they're making is they're paying it for the cost. All right, now let's move on to another financial measure as well. It's called payback period. Another measure that we consider when we invest in a project or a business. We say, what would be the payback period? How long will it take you to bring this money back into your pocket? So the payback period is the time that is required to earn back the amount invested in an asset or project from its net cash flow. The payback period can be calculated by this equation number 5, cash invested divided by the net profit generated. So let's take a look into this example. Find the payback period for the company that invested 300,000 in a new production line. The production line produces positive cash flow of 100,000 per year. So what we need to do, we need to find the payback period, which is basically how long will it take us to bring the $300,000 back. So using equation number 5, we divide the investment, which is 300,000, divided by the positive cash flow of 100,000. So that means it will take that company to bring this money back within 3 years. So they could bring their money back within 3 years to return their money back invested in that line. Now moving into another concept, which is the return on investment, another important financial measure that we use it for determine if we're going to invest in a project or not. And again, this is very important chapter because for your final project, I'm going to ask you to find a feasibility study, to develop a feasibility study for a project that if your selection. And one of the things that I will be asking you is to use these measures, the ROI, the payback period, the break-even point, the net profit, and many others. Most of the measures that we will cover here, you should be using it in a feasibility study. So what is a rate of return or rate on investment, or ROI? Is the measure that shows the investment gains compared to the cost. We need to find the percentage of the gains comparing to the cost, and that can be calculated using this equation: ROI equal to the gains from investment minus the cost of investment divided by the cost of investment times 100. All right, let's apply this in this example here. Of course, these examples can be used, can be developed using Excel. All right, so here's an example. A business owner is thinking of opening a construction company in the area. To make this happen, he needs to invest $500,000. He's expecting a net profit of $120,000 per year, and he's planning to manage the company for 5 years. So what we're trying to find, the ROI for this company, for this investment over the 5 years. The first thing that you want to do is to calculate the revenue in 5 years. That would be 5 times 120,000, which is equal to 600,000. And now the ROI would be equal to 600,000, which is the money, the profit that we generated during this period, minus the initial investment, which is 500,000 divided by the 500,000. And that would be equal to a 20% rate of return. All right, now moving into another important concept here called profit margin ratio. Sometimes we have companies who are selling their products with a high quantity, and you look into the figures, you will see, oh, wow, that's great figures of sales. But however, we need to also consider what would be the profit. And this is what would be the measure that we should use to calculate the profit comparing to the sales. So profit margin ratio is percentage of sales that turned into profit. So for example, if we said 35% in profit margin means that a business making 35 cents for every dollar of sales generated. All right, let's take a look into this equation. So the equation for this measure would be the net sales minus the cost of sold products divided by the net sales. And in order to understand this concept, let's take this example. Creative is an advertising company that would like to know their profit margin ratio. The following information is given to you. Net sales is 102 per year. The total cost is 39 per year. And we're talking about thousands here. So the answer, in order to find the profit margin or the gross margin ratio, that would be 102, which is the net sales minus the cost, sales minus the cost divided by the cost. So 102 minus 39 divided by 102, that will give you a 61.74. What does that mean? For every $1, that they're selling, they could make 61 cents. And the other 38%, the 38 cents will be toward the cost of $1 of sales. All right, I'm going to stop the video here, and I will see you in another video on another concept that we use for cost estimating, which is the make or buy decision. I'll see you in another video.